Hi, everybody, and welcome to Real Vision Live. This is Alf speaking, author of the Macro Compass, and hosting today Peter Boockvar, who's the Chief Investment Officer at Bleakley Advisor Group and the editor of the Boock Report. Hi, Peter. How are you doing?
Hey, Alf. How are you? Good to see you.
Hey, great to have you here. And the news of the day and what we're going to talk about is, guess what, guys? Of course, it's inflation. We have seen a 6.8% headline CPI year-on-year print. That's, as I can remember, I was not even born when we had a higher CPI. We were laughing with Peter before about the 70s, where he was watching cartoons, I guess, and I was not even born. So today is quite an important day, and we have Peter to actually break down for us what does it actually mean to have a 6.8% inflation year-on-year print, and especially what's coming after that and how to position your portfolios for it. So, Peter, do you want to start giving us an overview of your view on inflation in general?
Sure. So I've been talking about the coming inflation since last year. I felt that what we saw with supermarkets last March, April, May, when the shelves were bare because you had this flood of demand as people were not eating out anymore and the supply side just couldn't keep up, was potentially, at the time I was thinking, maybe a dress rehearsal for how the coming months, quarters, and years would progress. Because at the time, we threw a lot of money at the economy and supply chains were all screwed up because of COVID. And that, of course, accelerated as we are today. And then you throw in, of course, monetary policy being also as easy as it is. Now, that said, and while I've been saying that inflation is not transitory all year, I do think on a rate of change basis that probably February, because the comparisons get tougher, that the rate of change will begin to slow. So I think the debate from here, since there is no more debate about the transitory or not this past year, the debate now from here is, does inflation slow to a pre-COVID level of 1% to 2% sooner rather than later? Or are we going to have another couple of years of, yes, slower inflation from the peak, but maybe a 3 to 4% type year-over-year increase until we then break maybe to that 1 or 2? I still think that we have a couple of years left of 3 to 4, slower from what we're seeing now, but not going back to that 1 to 2% just yet.
Yeah, thanks for your view, Peter, but let's break a little bit down for our audience the very important point you made about what's called the base effect, right? So obviously year-on-year inflation growth rates are measured compared to last year benchmark or starting index point. And you pointed out very correctly that, of course, as the base for measurements of early 2022 inflation or mid-2022 inflation will be the already pretty high number of 2021, then it's very likely then the rate of change will probably slow down a bit from here. But going forward, you talk about an inflation which is persistently higher than the Federal Reserve target of around 2%. So my first question is, why do you think this inflation will remain sticky to 3 to 4% area, which is effectively pretty robust?
So to break down the inflation numbers, is we have services inflation, we have goods inflation, and then we can sort of put on top of that on the inflation numbers, is we have services inflation, we have goods inflation, and then we can sort of put on top of that wage inflation, because that then can filter into both. So services inflation is always persistent, is never transitory. And I've said this on Real Vision before. The 25 years leading into COVID, services inflation ex energy averaged 2.8%. And the read today is at 3.4%. And this is before we're really capturing an accurate measurement of rental gains. So apartment list, which is one particular gauge, in their November report did say that, yes, from October, rental gains were basically flat. But year to date through November, they're up about 17%. The BLS, Bureau of Labor Statistics, said that rents are now rising 0.4 per month, but they're still up only about 3.5% year over year. So it's not even close to what's actually happening on the ground. So I see services inflation, mostly driven by rents, to be aggressively strong all throughout this year. And then we have, of course, the good side, where the 25 years leading into COVID, goods prices, core goods prices, averaged 0. Now they're running north of 9%. And as you can see in the chart, that is a 40-year high. So the question is where do goods prices really settle out? Because you can be sure that services prices will continue higher. And I have argued that there's no doubt that supply chains will ease. It's just a question of to what extent, how much, and whether some of the increases in goods prices is more structural. And I will argue that it is. And while transportation costs are technically a service within PPI, CPI, that cost gets embedded in goods prices, since every single good that's made obviously has to be shipped somewhere and transported somewhere. So if you look at the container shipping market, we've had massive consolidation over the last 5 years, where the top 5 companies control that 60 to 65% of that market. And while they're building new ships, they have pricing power that they never really had before. If you look at the air cargo market, until we get air capacity back to where we were pre-COVID, and that means getting business travelers back to where we were, then you're going to have less capacity to deliver air, because a lot of passenger flights took that. So it's still going to be a couple of years, I believe, that you're not going to have the full capacity back when it comes to air. You know, rail is rail. Trucks, well, the Trump tariffs in 2018 into 2019 resulted in 1,000 trucking companies in the US go out of business in 2019. So that was a huge amount of capacity taken out. That was then further exaggerated by the recession last year, where 3,000 more trucking companies went out of business. Now, a lot has come, some of that has come back, but you're not nearly to where you were pre-tariffs in terms of trucking capacity. So that's going to take a couple of years to get back, therefore giving truckers more pricing power. And then you look at the whole global supply chain that became very dependent on just-in-time to do things very efficiently. Well, just-in-time, I've also said, is dead, and now it's going to be more just-in-case, and there's going to be more lead times to get stuff on the shelves, and it's going to be lower inventory turns, more working capital needs, less cash flow, and likely higher prices. And then you can throw in wages. And we know that wages are going higher. We saw that in the Atlanta Fed's November wage tracker data that came out late yesterday, which reaccelerated. If you are lucky to be in the age range of 16 to 24-year-olds, your wages are now going up 10% year over year. And if you're a job leaver, they're going up about 5%. Now, granted, these wage increases, well, at least on the headline number was, I think it was about 4 and change, but the job leaver number was 5. That's still below the inflation number of 6.8% that we saw in CPI. So wages are going up, but still barely keeping up with inflation. And the question is, from an employer standpoint, if you can increase your productivity, then you can best absorb those wage increases. But if you can't, or it will take you time to do so, well, you're going to try to recapture that margin, either cutting costs elsewhere or raising prices to your consumers. So I think that wage gains will continue throughout the year, which means companies will be raising prices. Now, one other thing to think about is recapturing margin is sort of a term that I heard a lot during third quarter earnings reports, and that a lot of companies are absorbing all these cost hits, but I do think that they want to recapture that in their margins over time. But if I'm a small business that's selling stuff to Walmart, and I'm just hit with a 30% increase in my transportation costs, I'm not calling up Walmart and said, hey, you know, I'm going to raise prices on that widget by 30%. Walmart's going to tell me to screw off.
Yeah.
I'm going to over the next couple of years try to nitpick my way and try to get back through higher prices what my my structurally higher cost structure now needs. So that's why I don't think we're just going to fall right back down again in terms of the inflation numbers. I think it's just going to take more time than some people assume.
Yeah, great overview, Peter, and thanks. You touched upon a couple of good points and important ones, which are second round effects of these inflationary pressures we're seeing. One of it is wages adjusted for inflation. This was another of the data points reported today. Basically the real weekly compensation year on year for employees is actually down 2%, 1.9% on a year on year basis. So the purchasing power of the median American is actually being eroded, as I pointed out in the macro compass a couple of times, because it's true that wage gains in nominal terms are being pretty robust, as you pointed out, but inflationary pressures have actually more than compensated for these nominal wage gains, making therefore the real adjusted, inflation-adjusted wage gains negative. And the second point you touched upon is the margin situation and the earnings. So the impact on earnings that these inflationary pressures and your view on inflation going forward is going to produce. So can I ask you from if we move from the more economic theoretical discussion into the asset allocation discussion, can I ask you what's your view on earnings going forward and on equities, therefore, as an asset class?
So in the third quarter, earnings were great, mostly speaking, because companies had a lot of success in quickly passing on their higher costs. The question is, to what extent could they continue to do that in the quarters to come? And I think that we're already seeing, at least as measured by the Michigan confidence number when they look at spending intentions, and also the Conference Board, that higher prices, at least on big ticket items like homes, major appliances, and vehicles, that consumers are becoming more price sensitive. And now we know that cheap borrowing costs by the Fed has helped to goose demand for those interest rate sensitive big ticket items, no doubt. But there is some sticker shock that is currently going on. So I think that that's going to be a factor in companies' ability to continue to offset these cost pressures. So I do think the third quarter was peak profit margin, especially if I'm right that these wage increases will continue, since labor costs for most companies are their biggest expense line. And again, while these companies will do their best to recapture that higher cost, at some point, consumers push back on that. And I do think margins will begin to crimp. And we did see some margin pressure. Some companies, were delayed in their ability to raise prices, no doubt about it. And we saw that in some of the consumer products companies, like even Procter & Gamble, that talked about that. But I do think that that's going to be an issue with margins, because these cost pressures are just coming left and right. Everything from the product that you're making to the packaging, because of higher plastics or resin costs, to the transportation of them, to the cost of the labor to make them, everything is going up. And that is one distinction of this inflationary moment that we're in, is that it is the most widespread in at least 40 plus years. It's not just like in the mid 2000s, we had a housing price inflation, and then we had commodity run on the upside. This is pretty much everywhere.
Yeah. So as we have to try and discuss basically the impact of these broadening inflationary pressures and, in your opinion, persistent inflationary pressures way above the Federal Reserve target, of course, my next question for you would be, how do you see monetary policy and the reaction function of the Federal Reserve evolving into 2022, as inflationary pressures, in your opinion, are likely to remain higher, broadly higher than the 2% Federal Reserve target?
So the Fed's already messed up the process by waiting and overstaying their welcome with QE, because of the problem that Powell had in 2018, when he was actually shrinking the balance sheet at the same time raising interest rates. So they were double tightening. The Fed made it a point that, okay, we when it comes time to tighten, we need to separate the two. And we can't raise rates until we finish QE. Well, by waiting as long as he did to even begin ending QE, tapering QE, there's still many months to go and a couple of quarters to go before they even get to the situation about raising interest rates. Now, we have to understand that QE is really a goose to asset prices and monetizes government debt. I'm stating the obvious to Real Vision viewers, while it's really the change in the Fed funds rate that can more directly impact demand. And we know that the Fed announced their taper, and they're going to announce next week potentially a doubling of that taper. But that means that they're still adding liquidity, at least over the next 4 months. And then we'll finally get around to the debate about what they're going to do with interest rates. But the problem the Fed has is they're so afraid to slow the demand side, even though that's what monetary policy directly affects, is the demand side. And they essentially have their fingers crossed that the supply side will somehow fix itself. Therefore, they'll be able to take their time with respect to raising interest rates. But because of the intermingling, and this is also because of the intermingling of asset prices with the overall economy, is that only if you believe in free lunches, you think that the markets and the stock market and credit markets will be able to skate through ending a $1.44 trillion annualized asset purchase program going to zero in 4 months without any accident, and be able to skate through a rise in interest rates thereafter with valuations where they are, with credit spreads as tight as they are. The Fed came out with their flow of funds statement this week, which is essentially the balance sheet on households, businesses, and the government. And household net worth, which net worth being predominantly real estate, stock and bond portfolios, money market funds, savings in banks, in the bank, as a percent of disposable income. So basically separating asset prices from what people are actually earning, is approaching 800%. And that's a ratio well above where we were in 2007 at the peak of the housing market, and in the first quarter of 2000 at the peak of tech. So because of that sort of ancestral nature of the asset prices in the economy, that is why I think the Fed has always gone so slow in tightening relative to how fast they go with easing. And of course, we learned about their focus on financial conditions helping to drive their monetary policy. So what they will lay out next week, to basically bottom line the answer to your question, is, yeah, they're going to speed up tapering, and we're going to have the dot plots, and we're going to have them all sort of predict how many times they're going to raise interest rates this year and next. But understand that there's one thing to have their plan, and there's another thing to actually execute that plan. And you can be sure when markets break and there's a correction in the market, the Fed will then take a step back. The problem this time around is inflation is going to remain high while they take that step back, which will then limit their ability to how much they're going to take that step back. So there's going to be a decision that's going to have to be made: is, do we focus on the inflation side, or do we try to save asset prices and keep them high? And at least their initial reaction was probably asset prices, but that's going to be, I think, a very important story in 2022, and both looking at how the economy is going to respond, but also markets too.
So what you're saying, Peter, is that the Fed put, as it was framed a couple of times, is much weaker by design this time because of inflationary pressures remaining elevated, which basically, means that if they want to pivot back in case asset prices would decline again, or there will be an accident during this tightening period, their hands would be pretty much tied effectively. That's your point.
Yeah, that's what I'm afraid of. When you look at the Fed put over decades, it was the Fed saying, okay, if you run into trouble, sell me your stuff. I'm backstopping. But because of the inflation story, the Fed is maybe going to. Like that strike price is not on a listed exchange, so to speak. It's more of a bespoke option now that may or may not sort of be defended.
I see.
Maybe it's Lehman Brothers now that is selling you that put. Maybe or maybe not, they'll make do.
All right. So basically, we have painted the picture for our listeners, which is not the most rosy one, because we talked about potential compression in profit margins from companies. So from the, let's say, the profitability perspective, some sectors, at least of the stock market, might be under pressure. As we go into next year, we're talking about sticky inflationary pressures for 2022. That seems to be your base case. We're talking about the Federal Reserve and other central banks by design with their hands more or less tied. But in general, if I understand you correctly, you're still pointing to them on a net tightening bias. So the Federal Reserve will accelerate the tapering plan. They will try to adjust monetary policy to a less accommodative stance. Which normally, at least for the front end of the bond market, as we are seeing, is not very positive, because traders tend to reprice expectations of their hiking cycle and their front end interest rates. But where is the place to hide then? I mean, if you're an investor today and you're looking into 2022, the front end of the bond market seems to be relatively toxic. Cash is a place where your real interest rate is negative, so your purchasing power is being eroded. And we just discussed the stock market, where at least from a profitability perspective, you didn't seem to be extremely optimistic. So what would you suggest an investor actually to lean on today?
So unfortunately, there's no good answer. I would have to say, investing is hard enough, even though it maybe seems easy when everything just goes up. But looking back at 30 years of doing this, it always seems a challenge, but now maybe even more challenging. So just to talk how we are doing things here and the portfolios I manage is in a way you want to lose less if markets do turn down, and that losing less is not necessarily the best strategy, but it could be a good strategy relative to other things. I've been very bullish on commodities, because not just of a cyclical rebound, but because we have essentially 5 to 10 years of underinvestment in a variety of them, particularly energy. I remain bullish on oil and gas stocks, and I think that this recent pullback we've seen on the SPR release and OPEC saying they're going to continue raising production, I think is a gift. And again, I don't know where the markets are going to go, but I know the tailwind for oil and gas stocks is still pretty strong. I'm still pretty bullish on agriculture, so I've been bullish on the fertilizer stocks. I think gold and silver have been a major disappointment in 2021, considering what inflation has done, what other commodities have done. But I do believe that the Fed will go very slow with any tightening, will remain well behind the curve, and will not even get close to catching up to where inflation is. Therefore, real rates will remain very negative. And I do think that the best days of gold and silver are ahead. So whether that's owning physical or it's owning the miners, which are dirt cheap, I think is a way of trying to maneuver through this. I still think that there's opportunities in certain value stocks. I mean, there are stocks you can buy at 9, 10, 11 times earnings that I'm not going to say that they're going to be immune to any trouble, because cheap can get cheaper and value can get more compressed. But at least there are lower expectations embedded in a low multiple. I would be more concerned about the high PE stuff, or I should say the high PS stuff, because some of these high flyers don't have earnings; they have only sales. And I think people have to understand the influence of multiples on performance. One of the great things about a bull market is not just a good earnings story, but you get multiple expansion. And one of the reasons why stocks in a bear market can fall 50% plus is because you get multiple compression in addition to a decline in earnings. So I don't necessarily know exactly where earnings are going to go next year, but I would have to believe that not just with Fed tightening going on, but with monetary tightening going on around the world, that you're more likely to get multiple compression than multiple expansion. And run your numbers that if a multiple of 30 times goes to 20, and your earnings and your sales stay the same, well, your stock's going to go down 33%. So I think that investors should be just more sensitive to valuation. I mean, one of the characteristics of the last bunch of years as investors, particularly younger ones, have been valuation agnostic. Well, now's not the time to be that way. And all you have to do is ask Kathy Wood about being valuation agnostic. And the company could be the greatest thing. The technology can be an incredible secular story. But when monetary policy shifts, valuations do begin to matter. And on the credit side, because you mentioned the yield curve, because we have obviously a large portion of client money in fixed income, it's not easy. And what we've told clients is you really have to look at your fixed income portfolio as an area of capital preservation. And it's not going to be the same buffer as it's been over the past 40 years. And it'll maybe hopefully eke out some return over a period of time and maybe be safer than stocks if we go into an equity bear market. But then that gets to, okay, where on the curve do I go? Well, you go short duration. Yeah, you reduce your interest rate risk, but as you said, we've seen a rise in short rates, but at least it gives you the flexibility to reinvest faster. Cash, I heard Ray Dalio say, oh, you can't own cash. You just said that a couple of weeks ago. Well, you know what? If next year's a troubled time for markets, well, on a real basis, yeah, cash will lose you money, but it's not going to lose you a penny in nominal terms, and it provides dry powder and optionality to take advantage of things that get hit or get cheaper. So I wouldn't just say, okay, I can't own cash because of where inflation is, because I'll take a no nominal decline, a real decline of a few percentage points if it beats a double-digit decline that we could see in other asset markets if I'm right on inflation and if central banks tighten throughout 2022.
So you made a couple of very important points. Cash is obviously an expensive option today, if you consider it as such, because it gives you flexibility and dry powder, but it costs you in real terms. For example, this year in 2021, as inflation in nominal terms will end up the year, in headline terms, will end up the year at about, 6 or 7%, and the interest rate on a compounding terms in the short-term instruments, cash you have generated is pretty much zero. It has been a relatively expensive optionality to own, but obviously everything must be considered on a relative basis. If next year your cash portion will cost you on a real optionality basis 3 or 4%, for instance, just to say, if other asset classes perform much worse than that, at the end of the day, it still provides some positive optionality and preservation of your dry powder, at least. So completely tagging it as a useless asset, cash is trash, seems to be a bit extreme to me too. And the other point that you made that I like a lot is total return on the stock market, as explained on the Macro Compass multiple times. It's basically the change in earnings, but also the change in valuations. And those two are interconnected, and there are actually spans of years in which earnings don't expand much. 2019, typical example, where year-on-year earnings on the S&P, I'm going top of my mind, were basically zero, but the stock market still delivered pretty much positive return because valuations were expanding. So it's pretty important to have a look at where valuations stand today, which in certain sectors stand pretty high, undoubtedly, and the link they have to real interest rates and nominal interest rates, obviously, because again, it's all of a relative story. An asset class is valued also relative to where the alternatives are, as you pointed out correctly. The question I want to ask you here is, what do you make of investors' expectations when it comes to inflation? I mean, is your view consensus in your opinion? The 1 year inflation break-evens in America are, last time I checked, around 4%. So if I look at inflation swap in 1 year from now in the US, the break-even is at 4%, predicting December 2022 inflation, headline inflation, to print around these levels. This number goes slightly down as we go into 2023. Do you think your view is consensus, outside consensus? Do you think investors are too relaxed when it comes to inflationary risks out there, or do you think stuff is relatively well priced?
Well, I do think I do think that inflation is going to settle out in the 3 to 4% range over the next couple of years, which is obviously a big slowdown from the nearly 7% we're seeing now, but it's still well above the 1 to 2% that we were in pre-COVID. And I think a big part of this discussion on where inflation eventually settles out in relative to expectations is that even if those expectations are met, are we in a world that is prepared to see persistent 3 to 4% inflation? Is Europe with negative interest rates, are they prepared for a period of time of persistent inflation? And let's just say it's not 3 to 4, maybe it's 2.5 to 3 there, but well above than what they're used to. You know, the world is sitting on this economic and market foundation of 1 to 2% inflation. When you look at debt levels, you look at valuations, when you look at how aggressive monetary policy has been. So even if call it the 3-year inflation break even, or even the 5-year inflation break even, being at 280 to 3%, which has been the recent range, let's just say that that's right, and that we're talking about a 3% 5-year inflation rate instead of 1 to 2. Well, that's a different ballgame. And yeah, 3% may seem low, but not in the context of where we are. Now, if the Fed funds rate was 3% today, if the 10-year yield was 4 to 5%, and we had, sort of pre-QE, pre-zero rate environment, or even pre the 1% that Greenspan took us to, we'd be able to, that's a shock absorber in a way. We'd be able to handle a period of time of 3% inflation. But you're just not there right now. We're in a totally different universe to the one that could unfold if inflation doesn't quickly fall back next year.
Yeah. So basically, you're pointing out to a divergence of pricing in markets where inflation expectations or break-evens 5 years from now, so in a relatively medium-term period, are pricing an environment in which inflation remains relatively sticky around 3%, which also seems to be your base case. But then when you look at Fed funds pricing or interest rate pricing from the bond market in nominal terms, this seems to top. The Federal Reserve hiking cycle seems to be priced to top at about 1.5%. So that's quite a difference when it comes to the nominal interest rates and inflationary pressures we're going to see, which basically means investors expect negative real interest rates for the foreseeable future and deeply negative interest rates. We're talking about negative 1.5% to 2% for the foreseeable future. Do you think central banks, not only the Federal Reserve, but central banks around the world, can literally withstand such a reaction function in the face of persistent 3% inflation, which, as a reminder, is generally way above their target, for multiple years in a row without then overreacting and then, basically over-tightening to compensate when they all of a sudden freak out on the fact that inflation expectation might become the anchor, not the upside? What I'm basically asking is, are you afraid that they will pivot their stance to something that is much more hawkish to basically overcompensate for what they have done for the last few years? Or do you think that's not a risk?
I think there's little chance we're going to see, unless you're at the Brazilian central bank, who raised 150 basis points this week and said you're going to raise another 150 basis points in February. They'll at least in the developed world, the most hawkish you'll get a central banker to be is just less dovish. They're not going to be hawkish because of the sensitivity that markets have to their policy. And one of the main factors when you look at the economy next year is the dependency that at least the U.S. economy has on high income spending. And that the top 10% spend, I think, like 40% of retail sales. Well, if the markets fall, you can be sure that those spending habits are going to change. And maybe that's what slows down inflation next year. is the markets, hit the wall and consumer spending dries up, and that's how you get to an equilibrium between supply and demand. Is that you get a big drop in demand because markets fall because of Fed tightening. Maybe that's what gets you to lower inflation, which is a possibility.
Could be.
That's still a major economic problem. So the economic problem is either going to be caused by the inflation, which impacts household spending and business profit margins, or it's the response of tighter monetary policy that hits demand, that hurts markets, that then hits further demand, and then we get less inflation as well. So there are a lot of tough scenarios, and it's unfortunately almost a pick your poison type situation that I see unfolding here. I always want to try to see how can we maneuver through and make it pass this without any problem, and everything points to more of a problem. Now, we could get through this if the supply chains quickly catch up and inflation numbers recede and central banks can take their time, then maybe. But I have lower probabilities on that relative to other probability type outcomes.
All right. So we have a question, Peter, from the audience. Actually, Jeffrey is asking, and I'm reading here. What about long duration treasury? Is back to a 60-40 split a way to stabilize portfolio returns in 2022? I guess he's picking up on your comments before about capital preservation, the role of fixed income, and the fact that you might foresee some drawdowns in risk assets next year. He's asking whether long duration position might help stabilize that portfolio returns.
It's a good question, because that's been really the important buffer to equity declines when you look at the last 20 years and the two bear markets that we saw in other corrections, is you get that rally in long-term bonds. And it's a really tough question to answer, because I don't know where the long end shakes out in all this. Historically, yield curves flatten when the Fed is tightening, and they steepen when they're easing. So we've gotten a lot of curve flattening, and it really started in earnest in mid-June when the Fed said they're now talking about tapering. And now you have the flattest, at least the 5s and 30s, since March 2020. So, but that said, the 10-year yield on the year at 145 is still up 55 basis points on the year. So you're still losing money in bonds, even notwithstanding the recent rally. So I guess the question is, do we get further yield curve flattening, but because of inflation being sticky, rates along the entire curve go up, therefore that 40% being in bonds doesn't help you? Or do we get the curve inverting or narrowing further, but rates are staying around these levels, and you get a rally in long bonds that can offset any decline in equities? And I really I'm not sure the answer to that question. But to what I said earlier, I think we have to accept the fact that with the starting point of rates being so low, that 40% of your portfolio of a 60-40 is at best not going to make you much money. And hopefully at worst, it'll lose you only a little. It's not going to provide the 5 to 7% returns that many people are accustomed to over the last couple of decades. I just don't see that happening, at least looking out the next couple of years.
Yeah. And then Dorcia, again, from our audience, is asking, and that's another interesting one, any view on the dollar index, the DXY? So as a reminder, the dollar index measures the dollar mostly against the euro. It's more than 50% of the weight in the index, but in general against other fiat currencies. So always as a reminder, you're measuring the dollar against other jurisdictions, mostly against the euro. But let's answer Dorcia's question. DXY.
Yeah. And if you add the yen, you're at 70%. So I like to look at the dollar against individual currencies. And I think that what we've seen over the last couple of months are interesting in a couple of ways. I think the dollar rally against the yen specifically has really been because of the rise in energy prices. And that because Japan shut down most of their nuclear plants, Japan is much more sensitive to changes in energy. prices because they import so much of it. So the higher the prices go, the more yen they need to convert to dollars to buy that energy. So you can actually, over the past year, chart pretty much in sync the price of oil and the yen. Then we look at the euro, of course, and we know how dovish the ECB is. We know that they can't even end their emergency program until March 2022, let alone think about getting out of negative interest rates or even their other asset purchase program. So interest rate differentials have clearly dictated the euro-dollar relationship over the last 6 months, I would say. The dollar-pound, the pound fell a lot after Brexit. It then rallied when it became a done deal. It's now weakening again because the Bank of England got cold feet when they were supposed to raise interest rates in November and decided not to. And now Omicron may kick the can to 2022 and them raising rates instead of next week. So the dollar has its own dynamic against the pound. Then, of course, we know the dollar has its own dynamic against the Turkish lira, for example. But if you look at the dollar against the Canadian dollar or the Aussie dollar, that's actually traded more similar to the dollar yen on energy prices. But on the reverse, where oil's gone up and the Canadian dollar and the Aussie dollar have gone up. So I think we have to look at the dollar more of individual cases here rather than the dollar's going up against everything or going down against everything. And actually one currency it's going down against is the Chinese yuan, where the yuan is at the highest level against the dollar since around 2018.
Very comprehensive answer from Peter, who really broke down the DXY against each currency, which I think is the right way to look at it. We have one last question from our audience I'd like to ask, which is a really good one from Luis, and he asks, Peter and Alf, the future outlook you've painted is quite grim. Is there any hope for a millennial? I guess he is a millennial listening to us, so I'll let you answer the question, Peter, first. Can you give any hope to Luis? And then I'll try to give my answers too.
Well, I'm just trying to figure out how to maneuver through the next year or two. As a millennial, still got a lot of time ahead of you. And if anything, someone who's young and has money to invest, wouldn't you rather be investing when prices are cheaper rather than when they're at historic highs and historic valuations? So I would, what we tell clients here is that if you have big liquidity needs over the next 2 years, if you need to pay for college, if you need to pay for a wedding or a big party or something, well, have that money in cash. Don't have it riding on a meme stock or a crypto. Have that money sitting in cash, just so you know, and you can sleep at night, that big financial obligation is put aside for you. And that helps you avoid a lot of any pain that we see the next 2 years. And if anything, if we do have difficult markets, well, if you have cash, if you have short-term bonds that you can quickly convert to cash, well, embrace lower prices because that actually improves your longer-term returns the cheaper you pay for something. And you know what? This is not going to be the end of the world in the next couple of years. If I'm right, we'll get through it just as we've gotten through everything over at least this country, hundreds of years, and we'll get through this. So no reason to fret when you're young and you have a lot of time ahead of you, because a lot of this is about time horizon. And I'll finish with this. One of Warren Buffett's secrets was not just his discipline and ability to find good businesses, high return on equity companies, and so on. It was his time horizon. He embraced declines in markets because it allowed him to buy things cheaper, and he was willing to ride out bear markets. So take that advice. Time horizon is your friend. A longer time horizon is your friend when it comes to investing.
And that is a fantastic hint from Peter that I would compound myself. So the power of compounding long-term investing is great. The law of compounding works your way, and long-term objectives should always be part of what you do with your investment portfolio. But I'm also going to add that technology has, of course, revolutionized our society, but that has also, generally speaking, lowered entry barriers for knowledge and lowered entry barriers for investments in yourself. So if you're a millennial today, but also if you're not, one of the best investments you can ever make is on yourself. And as per today, we have so much information available on the internet, and also the entry barriers for opening businesses in certain sectors have actually been lowered. So probably the best investment you can make is in your financial education, in yourself, and in having, as Peter said, long-term horizons for your investments, because as we go through this difficult period, there have been others in the past, and we've also gone through those. So just, follow the great Peter advice and have long-term horizons, and also invest in yourself would be my answer. Peter, this has been a very fruitful interview, I think, for our audience and for anybody else who has listened. Can I ask you to basically tell our audience where they can find you or follow you if they want to know more about your macro thinking?
So they can read my daily thoughts at bookreport.com. They can subscribe. It's BOOCK report.com. And our wealth management firm, it can be found at Bleakley.com. Yeah,
so guys, please follow Peter, follow his work. As we have seen during this interview, he's a very grounded investor with very elaborated views, but he can break them down very simple for everybody. It's a great wealth of information. Follow him. If you also are interested in my macro view, you can follow me at the Macro Compass on Substack. It's a free newsletter. Thanks everybody for listening to this Real Vision Live interview with Peter, and we'll see you soon.